Hello, everyone. A very warm welcome to today's webinar. Thank you to those that have joined already. But we are expecting quite a few people from different today, so we'll just give them a few more moments to log in. And whilst we do, I'll run through some simple housekeeping to get us started. Your microphones will be turned off and your cameras are off as well, so just sit back and relax and focus on the discussion. If you'd like to ask any questions on the control panel, there's the Q&A tab, so please do use that, and we'll try and get through as many of those questions throughout the webinar and the Q&A session at the end. To answer one of the most common questions, yes, the webinar is being recorded, and yes, you'll receive that recording to your email once we wrap up. You'll also notice there's a resources tab in your control panel, and that's where you'll find a useful link, including today's featured research. That is our flagship annual report, Are You Ready for 2026? So this is a forward-looking deep dive into the key themes that are shaping FX bits in the year ahead. Now, the speakers for today, let me introduce them. My name is George Vesey. I'm the lead FX and macro strategist here at Convera, based in the UK, and I'll be hosting and facilitating today's webinar. I'm joined by my colleagues Antonio Ruggiero, also based in the UK, and Kevin Ford joining us from Canada. So together we'll be sharing our perspectives and insights to give you a truly global view of the macro market landscape. And in terms of the agenda, as you can see, after an economic outlook from myself, we'll delve into the key global themes, which I've highlighted there, sections 2, 3, and 4. They're going to be led by Antonio and Kevin. And then we'll finish off with our FX outlook, looking at some of the forecast scenarios for the major currencies like the US dollar, euro, pound, and the Canadian dollar. And we'll try and save about 10 minutes for Q&A at the end. So again, as a reminder, remember to use the Q&A function in the control panel to ask any questions. Now, before we look at the year ahead, firstly, just wanted to set the scene a little more, reflecting on the year that's just gone. When we presented our outlook for 2025 about this time last year, we highlighted trade tensions as a key risk, whilst also expecting the cooling inflation and a reduction in interest rates globally could provide some stability to global growth. And that did prove broadly accurate. I wanted to share a couple of key charts to illustrate this from this year, the scale of disruption in terms of trade. The US trade policy uncertainty index surging to levels far above previous periods of instability. The tariffs that we saw drove China's exports to the US down over 34% in May. That's the steepest fall that we've seen since the pandemic shock of 2020. So as anticipated, trade frictions, supply chain pressures, the shift in policies that we saw continue to reshape the global landscape and trade landscape. In terms of currencies, in terms of FX, this time last year as well, we cautioned that the dollar's strength after Trump's election victory could prove short-lived if those tariffs that were implemented were going to be more aggressive and more severe than expected. And again, that call did prove accurate. And so drawing on a couple of key charts here first, the rare dynamic that we saw this year with US yields and the US dollar decoupling from each other. So this chart here showing the 1 week change in yields in the US dollar once those tariffs were unveiled. And Kevin will be unpacking this in more detail later on. What's clear of this year has been the sharp depreciation of the US dollar. In fact, it suffered its worst first half year performance since 1986. That is something that we didn't predict outright, but our FX forecast scenarios, using that scenario-based approach, it was quite effective. So if we consider, for example, our euro dollar forecast range of 0.98 to 1.2, this time last year that might have seemed highly excessive, but it was actually broadly in line with the eventual trading range of 101 to 119 that we've witnessed this year. So again, just to reiterate, this alignment really underscores effectiveness of our scenario-based methodology in capturing the breadth of possible outcomes when it comes to FX. Now, in terms of the economic outlook, in terms of the global economy, This year, 2025, has certainly seen or shown resilience, though growth has remained modest at around 2.6%. We're expecting. Looking ahead to next year, we expect the global economy to enter the year with again positive, but again slower momentum. And if growth does ease to 2.4% as forecast, there it's going to be these 2 years together would mark the weakest stretch of global expansion since 2009, excluding the pandemic shock of 2020. Now, the balance of risks, we think, hinge largely on developments in the US. Are we going to see more US economic exceptionalism, or will this end in 2026? Are we going to see a sharper slowdown in the US labor market, which tips the economy into recession, and that has spillovers into global demand, which of course it would. I think the main unknown is the knock-on effects of high US tariff rates at the moment. Of course, the most significant downside risk we think is an escalation of the trade war, which would weigh heavily on growth worldwide. Said there are upside scenarios, a fading of extreme tariff risks that would prove relief, fiscal reforms, targeted stimulus would act as a buffer to all of this as well. Equally, monetary easing, so central banks cutting interest rates are going to provide a tailwind by lower borrowing costs, supporting investment, boosting demand. But of course, the effectiveness of that depends on inflationary trends and policy credibility. And also bear in mind that central banks have already delivered several rounds of rate cuts. So while there's scope for more easing, I think the scope for aggressive easing from here is narrowing, and therefore we think that any major policy-driven growth surprises next year are probably going to come from the fiscal side. But all in all, as you can see from the chart, we do expect a weaker growth outlook going into. So with that backdrop in mind, what are the key themes that we're watching as we head into 2026? To talk us through these, I'll hand over to Antonio and Kevin for all. And remember, these insights will set the stage perfectly for our FX outlook that we cover at the final section at the end. Antonio, over to you.
Thanks, George. Thanks so much. Thank you for the introduction. Now, geopolitics. When we talk about geopolitics, what does come to mind? Is it war conflicts, like the war in Ukraine? Is it terrorist attacks like 9/11, or even the COVID-19 pandemic? I believe that as we've entered the 21st century, and actually, especially within the 2025, I think that what really counts as geopolitics has broadened. I think we should start also including issues like trade isolation, economic fragmentation, the rise of protectionist agendas around the world. All these themes are ultimately feeding into this anti-globalization story that we've been hearing about for some time now. It goes without saying that the implications on markets, especially FX, will be quite meaningful. Now, geopolitical risk isn't occasional anymore. It's actually way more frequent. As we look at this chart here on the screen, from 2015 onward, we can see there has been a clear pickup in media attention around geopolitical news. Now, what's unique about this risk is that it's very hard to quantify. It's hard to predict. This leads to very extreme scenarios. You have high periods of volatility, like we saw in April, May, when Trump announced tariffs around the globe, followed by surprisingly calm moments of low volatility. Investors simply cannot quantify. They ignore this risk until they then get hit when those geopolitical flare-ups make a comeback. In other words, markets tend to react rather than anticipate. But I would argue that there is another reason we've seen a return to low volatility environments today. Geopolitics today is quite of a pervasive force. It's entrenched in politics. It builds up over months and years until it manifests in ways that we did not see coming. Let's think about late summer 2025. We had a global bond sell-off. Bonds fell off across the board: Japan, UK, US, and a few months later, this happened again. So what's really happening here? As we take a look at the next slide, governments are starting to look inward. Germany is moving away from those traditional debt ceilings. Instead, is really boosting promises of investment in defense and the environment. Again, geopolitical themes. The UK is stuck in what seems to be an endless fiscal hole, amplified by weak growth and high inflation. Again, both byproducts of the UK's protectionist phenomenon of the 21st century, Brexit. And then the US, which is coming up with these very sort of unorthodox and quite creative ways to meet debt obligations, that is, tariff revenues. So as a result, what's actually happening is that there is this lingering anxiety in markets that's cutting across borders and that's making volatility quite global in scope. The 2025 summer bond sell-off, in fact, wasn't the result of a country-specific episodic event, but rather it was the multi-year build-up of fiscal and inflationary pressures that stem from geopolitical fragmentation. So in fact, looking at this chart here on the screen, long-term borrowing rates have inflated over the past years. Why? Well, real rates have gone up, yes, but also the risk premium, which is that extra return investors demand for perceived risk, has also gone up. More spending tied to isolation makes investors wary about debt sustainability naturally. They question whether the governments can meet those obligations, especially when isolation itself becomes a costly endeavor. Reroute trade routes, raw material shortages, production delays, all of these feed into weaker growth outlooks, lower tax revenues, and reinforce ultimately investor fears. As we move on to the next slide, looking at trade, today we can argue that the more embedded an economy is in the global system from a trade standpoint, the more exposed the economy will be to shocks. Let's think about Canada, Mexico, the Eurozone. They're all highly dependent economies dependent on trade. But when US tariffs kick in, suddenly we all start worrying about their economic outlooks. And I think the Eurozone specifically is a great example. We saw the euro appreciating about 13% against the dollar in the first half of 2025. But that strength in the euro also pushed, almost cornered ECB officials to consider an extra cut. An export-dependent economy will try anything it can to avoid a stronger currency because that will hurt ultimately export competitiveness. This really shows us how pervasive this new form of geopolitical risk has become, as it can easily spill over onto other asset classes like currencies. As a result, these sort of episodic country-specific instability is just the amplifier of what has become a baseline systemic feature of the global economic and financial system that is geopolitics. Now, bringing this all back to businesses, smart solutions today are going to be less about rigid models and more about resilience. Businesses need to stay flexible and proactive, rethinking how they protect against risk in an increasingly fragmented world. The old just-in-time, extra lean approach almost feels outdated. In times like these, having a buffer can make all the difference because ultimately dependence has become an expensive vulnerability. That's it for me. I will now pass it over to my colleague, Kevin. Thank you.
Thanks, Tonio. Good morning, everyone in the East Coast. Afternoon for you guys in the UK and Europe. Well, thank you very much. Let me just jump into this topic of monetary and fiscal policy. Over the past few years, economists, analysts, and even CEOs have consistently predicted a recession in the US. And globally, really, we haven't really jumped on that bandwagon of forecasting a recession, even though financial media spends a lot of time on recession watch, as you're seeing right now. It reminds me of this famous joke by the Nobel-winning economist Paul Samuelson once said, 9 of the last 5 recessions have been predicted by economists. If you keep calling for a recession, you'll eventually be right. But there are several reasons why the US hasn't hit a recession. The AI-driven economy, the K-shaped recovery that sees high-income households keeping the boat afloat. But perhaps less discussed is the government spending to this. So I'm going to focus on this third factor that is really not so discussed. Traditionally, the idea was simple. The central bank raises interest rates, so it makes private credit more expensive. This tightens financial conditions, and through transmission channels, this slows growth. Sometimes even leads to a recession. But since the great financial crisis, and especially after COVID, the engine of liquidity isn't just credit, but it's government spending. So, for example, by almost every measure, the US federal government spending is running at or near all-time highs. This spending acts like guardrails for the economy. It limits how weak the economy can become in aggregate, but it also introduces inefficiencies. Public sector spending tends to be less productive, which may place a ceiling on medium-term growth. So in general, fiscal policy, what we're seeing is that it's increasingly shaping the direction and composition of the economy, often more so than monetary policy. Fed Chairman Jay Powell, he flagged this just a few months ago in his Jackson Hole speech. He noted that during the Fed's 5-year reassessment of its monetary policy framework, that structural factors like productivity, demographics, and fiscal policy are all pushing the neutral rate higher. So this marks a fundamental shift in effects and markets, of course. This effectively closes the chapter on the zero interest rates era. And for FX, this means that higher for longer is the new baseline. And with that, political risk is increasingly becoming a pricing factor. Now, what do I mean by a political risk? So, the Fed's dual mandate, price stability, and employment, full employment, of course, but this is now colliding with government's need to manage soaring debt service costs. So we've seen this this year, not only in the US, but in the UK as well. We have from the government this debt rate dilemma. So we have higher rates that are aiming to fight inflation, but at the same time, these balloon fiscal costs. And this invites political interference. So heading into 2026, maybe the question is no longer when's the recession coming, but how sustainable is this massive government spending to keep the economy afloat? We're seeing it in the US, we're seeing it in the UK. Now, I just released a few hours ago in Japan. In Canada, the federal budget has been passed that increased the debt to GDP ratio to historical levels. So the key question is maybe not central banks will keep cutting rates, but rather how long can the US and other developed economies can sustain this level of debt? This is a big risk that we're seeing in 2026 as we see, for example, in the US, the government aiming to move or push the central bank to keep the interest rates lower, while the central bank is saying, look, listen, these factors are pushing the neutral interest rate higher, and we're going to go into this issue in 2026, where we'll see the Fed and government fighting really for who's going to be leading the economy and monetary and fiscal policy. So can we let's move into the next slide, please. The 2026 monetary policy outlook is a story of both convergence and divergence. So the Fed and the Bank of England, they face similar challenges: persistent inflation and political pressure tied to debt costs. The Fed may lower to 2.75 to 3.25 by mid or by October 2026, by tariffs and sticky inflation could delay cuts. Now, in contrast, you see the European Central Bank likely at the end of its easing cycle, supported by inflation projected below 2% and sluggish growth. And you see, on the other hand, the Bank of Japan slowly exiting decades of ultra-loose policy, likely hiking toward 1% by late 2026 as inflation stabilizes. So the deeper theme here again is, as we've mentioned along with Antonio, this new system of trade geopolitics, and debt, they're no longer moving in isolation, but in tandem. As we've seen in 2025, this is something actually Mohamed El-Erian, former PIMCO manager, he coined this term geoeconomics on a recently published article in Financial Times. Geoeconomics, the weaponization of trade and finance to pressure both allies and adversaries on non-economic issues, has created this more volatile environment for policymakers, businesses, and market participants. Now let's move to the next slide. So this macro backdrop has created this very challenging environment for the US dollar, and I'll just finish with what's been arguably the market theme of the year, the US dollar posting one of its worst performances in decades. The US stocks, bonds, and dollars sold off simultaneously, and that alignment shook investor confidence and triggered headlines questioning dollar's safe haven status. And there was this narrative back in April. It was called Sell America, that was dominating the narrative back then. That was driven by the reciprocal tariff announcements and growing concerns over the appeal of U.S. assets. If you recall as well, there was also a speculation about the Chinese government and dumping treasuries and the bond vigilantes. But here's the thing, that data doesn't really support that narrative. We've seen it so far. It actually, the data proves it wrong. Between January and June, for example, global investors allocated 30% of their US holdings to equities near record highs and well above the long-term average of 19%. So despite the noise, confidence in the US markets really has held up. And the data also shows that the dollar still accounts for 90% of FX trades, 66% of global debt, and 58% of reserves. So no other currency comes close, though there are incremental, slow shifts towards this idea of de-dollarization, but there's no collapse of the dollar. So we have to acknowledge there are different factors, such as central banks diversifying reserves, BRICS nations are invoicing trade in other currencies and are issuing debt in other currencies that are not dollar, of course, and new payment systems are gaining traction. But for now, the dollar's foundation, which is deep markets and open capital, it's still unmatched. And the problem, though, that we've seen this year and heading into 2026 is that its dominance is no longer guaranteed. The markets now demand a premium for trust. It's something that really has to be earned. Let's move to the next slide. So what explains the dollar's weakness? It wasn't really a broad-based exodus from dollar, but was driven mainly by hedging flows, especially from Asian investors using FX swaps to manage risk. At the same time, well, of course, as we've seen and discussed today, policy uncertainty introduced a risk premium, breaking that all correlation between market stress and dollar strength. And so just to finalize here and reiterate this idea behind this chart is that interest rates still matter, but you have these other factors in the sentiment that are explaining markets' behavior, as you see in this decoupling from interest rates and spot rates that have been diverging for the most part in 2026. Let's move to the last slide. So where do we see the US dollar going from here? The bar for a continued US dollar weakness has really risen, while the consensus view still points to further dollar weakness towards the end of the year and the beginning of 2026. There are several factors that make a continued decline more challenging. There's the resilience of US economic growth, the continuous floor provided by historical fiscal deficits, a cautious Fed, and a market that has already priced in much of the expected easing. So the dollar's performance is now more dependent on actual economic outcomes rather than just market expectations of a dovish Fed or what could happen really with a US trade policy. However, any misstep in US policy or any misstep really coming in communication, as we've seen in 2025 from the US administration in relation to trade with China, Europe, with Canada and Mexico, it will derail the US dollar recovery as we head into 2026. That is it from me. Thank you very much. I'll hand it over to G.
Thanks a lot, Kev, and thanks, Antonio, as well. Really valuable insights there about the global themes that we're keeping an eye on going into next year. With that context in place, the next section of the webinar is the final section, and that is our FX outlook. And before we get stuck into that, I just want to share a few remarks that we will be leaning on our own kind of our own bias towards what we think is most likely to happen. But as many of you know, we do believe that a scenario-based approach is the best way to understand the FX implications of different plausible events unfolding. So, we're not here to pretend to know exactly what's coming in terms of the exchange rate direction or exactly where the exchange rate is going to end up. The takeaway, therefore, over the next few slides is to not fixate solely on the baseline scenario that you see on the charts. And also, if those wider ranges, those extreme upside and downside tail risks do feel a bit off-putting for you, then focus on the central scenario, the grey area on the chart. That's defined as one standard deviation above and below the baseline forecast. So effectively, the 70% confidence interval there. This way, you're not relying on a single forecast, but instead you're preparing for a range of possible outcomes. And we think this allows businesses to position themselves not only to benefit from favorable currency moves, but also to be ready and protected against adverse moves, because we know they can happen, they have happened, and they might happen again. So I'll pass to Antonio to give us some insight on the most traded currency pair in the world first. That's euro dollar. Over to you, Antonio.
Awesome, George, thanks. Okay, so kicking off with the euro dollar, I believe there is one big difference in how euro dollar is going to be shaping up in 2026 versus 2025. 2025, especially the first half, it was really all about tariff threats and overall headline risk tied to Trump's erratic modus operandi. The markets were constantly on edge. They were always waiting for that next headline, and the dollar paid the price. It dropped about 13% against the euro. That move wasn't really about investors loving the euro, neither hating the US altogether. If investors just wanted US assets, it's not that USD volatility that came with it. As Kevin has mentioned, in fact, it was all about hedging against the dollar, with the euro acting as the second best liquid alternative. The euro didn't really have much homegrown strength. The macro picture was quite unimpressive, while the ECB kept on cutting rates, given that the tariff-ridden world was looming. It was not surprised to see, in fact, euro dollar detaching itself from where rate differentials were pointing. The ECB was easing, the Fed was hawkish, yet the euro still rallied, justified, however, by those fundamentals. But now the winds are shifting. As the second half of 2025 has already hinted, 2026 looks like the year where the macro and the policy rate paths matter more. This means that the Eurozone may actually be stepping up into the supply in driving Eurodollar more versus 2025, which was really the dollar driving the pair up and down. For the dollar, investors now just need that data. They need the data-driven evidence to justify the continuation of the 2025 dollar negative story. That is, data to validate those fears from early 2025 that tariffs are dragging on the US economy. Our view is that tariff effects will moderate in 2026 for both sides. But if tariff were to be more painful than expected, the US, we believe, better position to offset that drag, stronger investment and spending tied to the AI boom, along with optimism unlike in 2025. The Eurozone, by contrast, doesn't get the same AI tailwind. Its risks are more political and structural. Germany still hasn't delivered on those spending promises it made in 2025, weighed down by reform, paralysis, and a fractured government, with the country flirting with a technical recession in 2025. France's political instability is another swing factor with potential spillovers into the economic outlook. So while on paper, rate differentials do lean toward the euro, with the ECB having ended the easing cycle, while the Fed now with more to cut, we are skeptical the Fed will cut much farther, especially if inflation stays sticky and the economy keeps proving resilient. Overall, we see a more balanced outlook here for euro dollar in 2026, with fundamentals taking center stage. Our baseline points to 1.16 year end, though we lean mildly toward downside risk, with an inclination toward 1.15 as the more likely outcome. Extreme moves here look less likely than they did early in the year. The chances of euro dollar breaking sustainably above 1.20 appear unrealistic to us. That would really require a notable deterioration in the US economy and a return of the Fed independence risk premium, which at this stage we do see as likely. And in contrast, the odds of euro dollar pushing lower into those lower bands of our central scenario look relatively stronger, especially if the Fed cuts less or not at all through 2026 in response to ultimately a better than expected economic outlook. That's it for euro dollar. As we move on to the next slide for sterling euro, and I'll take this chance also to answer one of the questions that we saw coming through, which says, do you foresee the UK economy performing worse than other G10 countries in 2026? And if so, does that suggest sterling euro is likely to continue falling? Thanks, Justin, for that question. Now, sterling euro it's fallen about 6% year to date. Sterling euro is really probably the clearest channel which we were able to see that fiscal risk premium, which has been building up at the far end of the gilts yield curve, translating into sterling weakness. As a result, despite that Bank of England quite slow and careful easing cycle, we're looking at a cut every 3 months roughly. Sterling has weakened quite substantially against the euro on the fiscal strain alone. We believe that this fiscal risk will gradually give way as sterling's main bearish force. Sterling's main bearish force, but the Bank of England easing in 2026 will step in as the new dominant bearish driver for sterling, while fiscal tightening following the budget is expected to ease pressure at the far end of the yield curve, restoring some sense of fiscal discipline. The policies that follow will actually likely damp economic growth farther. And that is when the Bank of England steps in with this sort of built-up, uncut ammunition that it can now start applying more quickly and aggressively, also incentivized by inflation that appears to be easing at this point. Our baseline scenario here sees the Bank of England cutting rates down to the neutral level at around 3.25%, but also slowing quantitative tightening. Now, in an upside scenario for sterling euro, UK fiscal tightening drags growth, yes, in the first half, but it's offset by early year Bank of England easing, which supports the outlook later in the second half. Meanwhile, Germany's fails to deliver on those pending promises, which weighs on the euro, and France's fragile political situation flares up again. But in a downside scenario, we see Starmer being ousted, with those longer-term yields facing pressure again, jeopardizing an already fragile fiscal backdrop. That would also in turn erode economic output and overall weigh on sterling, which will then face pressure from both Bank of England easing as well as the fiscal risk premium. Now, our baseline view carries a mild downside bias with 1.12 as the more likely end 2026 outcome. Since these forecasts were produced before media leaks ahead of the budget, pushed sterling lower, that 1.15 level now looks overly optimistic. That said, we do remain confident in our central scenario with little risk of a sustained break below 1.12 or above 1.20. We see greater downside risk for sterling in the first half of the year before support builds later as the easing cycle ends and fiscal risk premium fades. By then, as sterling euro begins trading closer to rate differentials, sterling should benefit from relatively more attractive rates versus the euro, helping cap further downside, assuming, of course, that political and fiscal risks do not make a major comeback. That's it for me. I will now pass it over to George.
Great stuff. Thanks, Antonio. So that's euro dollar and the pound against the euro covered. I'm going to cover the pound against the US dollar now. Before looking ahead, just a quick summary of what we've witnessed this year and why. We've had a wide trading range, 14% about from 121 up to almost 138. Obviously, we pulled back from those highs recently, but despite the pullback, we're still around 5% higher. The pound's still around 5% higher against the dollar year to date, which means from a longer term viewpoint, the pound is actually on track for its strongest 3-year stretch against the dollar since 2004. That's if it does manage to hold above that 130 mark. Obviously, the direction of travel has been steered largely by US dynamics, with the policy making, the tariff upheaval driving the US dollar midway through the year. But also, the first half of this year was supported by resilient UK economic data that we had. And interestingly, our calculations show that the sterling dollar exchange rate showed a stronger correlation with UK data surprises than with US data surprises, which is an interesting one. And due to the fact that we had stronger UK data in the first half of the year, that also meant that relative rate spreads were favourable because of the hawkish repricing of the Bank of England relative to the Fed. We saw the UK-US 2-year yield differential widen to its highest in 2 years. So that reinforced this demand for the high-yielding pound. The second half of the year hasn't been so rosy, though. It's told a different story for the currency pair. Firstly, because of the rebound that we've seen in the US dollar, but secondly, because of the domestic headwinds that the pound faces with the UK's fiscal concerns, of course, the political instability, as Antonio mentioned in the previous slide. So looking ahead, the big question for us is whether sterling's resilience above that 130 mark, that psychologically important 130 mark, turns into sustained strength, or is it going to fade against renewed dollar momentum and ongoing UK fiscal challenges? So as you can see on the chart, our 70% confidence interval, that central range in the grey there, the top side of 137, the downside of 129, and we're obviously hovering around the lower end of that central range already. And I think the worry for the pound, of course, is if the UK economy doesn't show signs of meaningful improvement next year. The budget is already adding downside risk to an already sluggish outlook. And if we see inflation pressures continue to ease, markets quickly repricing dovishly, i.e. more aggressive Bank of England rate cuts, which just erodes the pound's yield appeal even more. So this could act as a major headwind. On its own, though, is that going to be enough to push sterling dollar below or sustainably below 130? Perhaps not. But if you combine that with ongoing fiscal credibility issues, persistent gilt market stress, and alongside that, an improving or US growth reestablishing itself as a pillar of support for the US dollar, then of course, if all of that happens at once, then we do think the balance of risks tilt towards the exchange rate moving to the 120 to the mid 120s next year. But as Antonio has highlighted, fiscal tightening and then therefore monetary loosening, so more rate cuts by the Bank of England, although it reduces the pound's yield appeal it may actually be seen as a constructive episode for the UK economic outlook, and especially in the second half of the year, it might prove supportive for the pound, especially if UK rates stay attractive versus G10 peers. However, I will note that despite breaking above 135 a couple of times this year, we have seen that to sustain above that level has been difficult for the pound. And in fact, over the past decade, the pair has spent less than 20% of the time above 135. So the question for next year is, if we do see some bullish momentum, if we do see some optimism in the pound, are we even going to see that break higher translate into sustained strength, or is it just going to be another episode of fleeting strength? Ultimately, the resilience test for the pound is not just on whether the UK policy mix is going to translate into lasting investor confidence, but it's also dependent on what's going to happen in the US. We do update our forecast on a monthly basis, by the way. So just be sure to check out our monthly reports, because we want to make sure they reflect the latest market developments, the policy shifts and macroeconomic trends. But that's sterling dollar from me. Kevin, over to you for the final FX forecast. The tale of two neighbours, the US dollar versus the Canadian dollar. Over to you.
Thanks, George. Yeah, so the Canadian dollar, it's been one of the worst performers amongst G10 this year. It's a story of trade and trade tension between the US and Canada and Mexico. The Cosmo deal review is poised for mid-2026, but as of now, the trade tension that started in January, February, as the new US administration began, it has sustained throughout the year. And the US CAD is only posting a gain of around 2% year to date against the dollar. And it's been really connected not only to trade tensions and escalating rhetoric, but also the economic impact. You've seen it in the second quarter of this year. The Canadian economy contracted by 1.6%. And the question is, are we heading into a big, steep recession? So we actually might avoid a technical recession here in Canada. Technical meaning back-to-back negative GDP prints. But if you see sector by sector, there are several that are already in a recession, and the different regions across Canada. For example, the auto industry in southern Ontario, they are in a recession. The labor market, it's in a recession. The youth unemployment has been hitting historical levels. Unemployment rate, it's the highest outside of the pandemic since 2016. Now, the latest data is showing that the macro data is starting to stabilize, but the huge drop of exports from Canada to US, of course, it has really made a huge impact in the economy. Now, what has on one side, you've seen the Bank of Canada responding 275 basis points that the Bank of Canada has cut this year. So sorry, since last year, and it's closer to what they see as the lower end of the neutral rate, so 225 right now. And we're seeing that it is likely that the Bank of Canada will pause probably until May, June next year, as they gather more information, mostly on the inflation side. We've seen this tangent story as well related to tariff, which has been the pass-through, which has been really slow. Big companies, they have had the ability so far to manage the tariff impact, and the pass-through has been slow. So we've seen some inflation, but not to the levels that alarm most analysts or central bankers in the US and Canada as well. But in Canada, we do have, similar to in the US, an issue with sticky inflation, mostly on the services side. And yeah, goods inflation as well has been really sticky over the last few months. But the key takeaway from the Bank of Canada's latest meeting was just a few weeks ago. They mentioned that the monetary policy, it can't really go so long. Really, there's limits to what the Bank of Canada can do in this type of environment. We're not talking about a traditional cyclical downturn in the economy. This trade policy coming from the U.S. has really not only shaken the economy, but also showed or just opened all the fractures and also the challenges that the Canadian economy has had over the last 5 to 10 years. And I'd say that Bank of Canada is done with monetary policy in terms of countering the effects of the US trade policy. And now we're moving into the other aspects of what fiscal policy can do to counter the effects of tariffs. The federal budget has passed. And you've seen probably different stories around the federal budget. Some worrying about the longer deficits, the higher deficits, and probably higher debt to GDP ratio in the next 5 years. The parliamentary budget officer, which is a nonpartisan institution, they have warned really that the numbers are really concerning for the long term. Now, but you have on the other side this need for the economy to restructure itself, to strengthen, and there's a need as well. We've seen it in Germany, as Antonio mentioned before, in Europe, in Japan. Most developed economies are having these, are living in this transition from COVID to from weakened consumption and weakened infrastructure and weakened productivity, that they really need to incentivize key sectors in the economy. And this is what we're seeing that this budget is aiming for. So for now, it has passed narrowly. It is voted yesterday, late evening Eastern time. And now it is the complicated part. So it's the implementation, lots of risks. But in general, I think that the message is positive, that we're now passing the baton from monetary to fiscal policy and these other aspects that need to line up to strengthen the Canadian economy. However, I'd say the highest risk as we head into 2026 is really anything related with the COSMA deal review. There are several paths towards that negotiation. For now, the trade negotiations are paused, and there are really any hints that this could shift in the near term. So we're seeing that base case scenario, as we've seen this year, between 136 to 142. The CAD is trading right now around 140 at the top end of its 6 months range. And it's gonna be really up to the upcoming macro data point, macro releases, and if U.S. monetary policy converges closer to Canada's monetary policy, closer to neutral rate, that will help the loonie. It will help us some sort of relief for the loonie if we see in 2026 the Fed easing closer to neutral, but will depend mainly on the inflation story. So that's why you see the baseline closer to the 140, unfortunately, for the Canadian dollar. That is it from me. George, passing it over to you again.
Thanks, Kevin. Great stuff. Now, conscious that we'll be talking for some time, so thank you for everyone for sticking with us so far. Appreciate there's a lot of content to digest, but that is the end of our presentation. So we've got time left for Q&A. We have had a few in already, so we'll address them. Antonio addressed one as well during the presentation. But remember, if you want to ask a question, just please use the control panel. We'll answer as many as possible. Antonio, I think this one will be for you, given your euro-dollar slide, I believe. It's from Hannah. It says that given the tariff headlines are less likely to affect the dollar much in 2026, as you pointed out, how might the Fed independent risk premium influence the dollar instead?
Thanks, George, and thanks, Anna. Great question. Short answer is yes, there will be an impact or when it comes to the Fed independence story, but quite limited at least relative to what we've seen in 2025 from tariff threats. The reason for this is I would say probably twofold. The first one is the dollar enters 2026 better prepared, as well as investors around the world, better prepared to deal with Trump's erratic policy agenda, which is, as a result, less likely to spook markets as much as it did back in 2025. Also, I believe the bar was set quite high when President Trump threatened to fire Powell, as we saw early in the year. Also, I would add another take on as to why the Fed independence story may have a more contained influence on the dollar, which is that I think we've probably all heard about this taco trade. Trump always chickens out, but I think there is no really been a better time than now to see that trade really unfolding. Specifics regards to trade, we've seen tariff levels actually being lowered across Latin American economies on some products specifically related to food. Now, why is this? The reason why this was done was to lower food costs for the American people. And this happens at a time when there have been some key democratic wins around states in the United States. So what does this really mean? The reason behind these democratic wins was really affordability, cost of living quite high. So I believe that the Trump administration is starting to feel that pressure, is starting to feel that political pressure. So when we get to May, when the new head of the Fed will be replaced, I believe that there is only an extent to which pressure can be put on the Fed in terms of lowering those rates, because those rates will ultimately translate into an even higher inflation, which is already above target. And I believe that can erode support toward the administration even more. And I think they will probably try everything to avoid that. Thanks.
Cheers, Antonio. I'll take this next one. It asked, do you have any forecasts on the Japanese yen? That's from James. The short answer is yes. The long answer is that we do think that the risks are skewed still towards the downside, despite the yen being heavily undervalued. It's weakened nearly 5% since PM Takaichi won the party leadership election. I think on the domestic front, this new administration's expansionary fiscal stance and the Bank of Japan's ongoing dovish bias that is likely to keep the yen under pressure. But as I said, it is highly undervalued, and with the US dollar Japanese yen exchange rate around kind of 160, I think is probably going to be the line in the sand for Japanese officials. And neither the US nor Japan really want a sharply weaker yen. And as I said, because the currency is already highly undervalued, if we do see that the pair just kind of drift back towards that upper level of 160, then we'll probably see some intervention from Japanese officials, similar to what we saw back in 2024. But I think the challenge really is that we are expecting, or there is a possibility of a low volatility environment through 2026, and that could fuel demand for yen-funded carry trades, which would weigh further on the yen. But again, if the Bank of Japan do raise interest rates once or twice over the next 12 months, then that's going to reduce the yield disadvantage, and it could trigger an unwinding of those carry trades. But yeah, we do have forecasts on the Japanese yen. You can find more information about that in the annual Are You Ready for 2026 report. But if there are any forecasts that you'd like on specific currency pairs that aren't in that report, then just reach out to your point of contact at Convera and we can get something bespoke over to you. Kevin, there's one for you here. I think if you don't mind taking this one, what is the single biggest macro risk you see in 2026? and which major currency pair would be the most vulnerable to that risk?
Yeah, I think that we've mentioned it, that it is kind of a story intertwined with with all the risks and the system that we're seeing moving into 2026. This trade, geopolitics, fiscal policy, and the interplay between monetary policy that creates a huge challenge for central banks to manage inflation and growth. So I'd say that the risk that markets aren't really pricing in right now, it is stagflation. I'd say that's the biggest macro risk for the US and for major developed economies. If you see inflation spiking up because of these slow pass-through from tariffs, these big companies, they've been eating most of the tariffs, but they can't, if the macro environment doesn't support these this environment that has so far helped them to eat most of these tariffs, they most likely will end up hiking prices, and this will then end up into a flaring inflation environment, and at the same time slowing growth. And as we've seen the story of the labor market in 2025, we thought that the labor market was resilient, and we are ending the year seeing the crackdowns and the cool down in the labor market. So these interplay between growth and inflation, and if we see the central bank having to decide between a slower inflation or stimulating labor market to stimulate the economy as well, but a point that it really risks to send inflation higher across the US and developed economies, then will be markets will really suffer in really trying to struggle what will be the next path in monetary policy for the US and the rest of developed markets.
Awesome, thanks, Kevin. In the interest of time, I think we just have got one more question, and it's from Fernando. Do you expect the gold price to continue rising in 2026 as a refuge investment? Antonio, do you want that one?
Yes, Fernando, I know I do believe so. I think we've seen gold hitting fresh highs this consecutively this year as a sort of a refuge investment. As we head into 2026, there will still be demand flowing into gold. Uncertainty around trade is still high. There have also been growing concerns around potential equity bubble, which will keep investors on edge, and that demand naturally flowing into gold. Plus, linking it back to the geopolitical themes, there is going to be this growing concern around debt sustainability across regions. Again, additional spending coupled with low growth, meaning less tax revenues coming in, will keep investors on edge, which may actually prioritize interest-free assets like gold over bonds, which are instead linked to the debt sustainability and fiscal health of economies. That said, I believe that the probably one factor that may actually cap a more aggressive upside in gold may actually be a stronger dollar. If the dollar is to continue appreciating from now onward, because the economy proves us that it's been more resilient than many of us had anticipated, a stronger dollar will ultimately weaken the appeal in gold as it becomes more expensive. But that's it for me.
Cool, thanks, Antonio, and thanks again to everyone for all the questions. I'm going to respect the time there and end the Q&A session. Just before making a few final remarks before ending today's session. So, firstly, to answer again some questions that have come through, you will receive the recording of today's session via the email that you signed up to this webinar on. You can also access the report, which contains all the information that you've seen on the slides and more. You can get that from the resources tab on your control panel. But I think it might be in the email that you get the recording on as well. If not, then head to our website where you can download it. And secondly, just a reminder that it's not just currency volatility and risk management where we can help you at Convera. You can talk to us about our trade solutions, how we help organizations accelerate payment speed or diversify into alternative markets, or you might be interested to know more about our automated global payment solutions, compliance controls, fraud prevention measures, lots of considerations. So do reach out to your point of contact at Convera if you want to learn more about any of this. Thanks again for everyone, to everyone for joining us today. Wishing you all the best and good luck for the rest of the year and planning for 2026. Thanks all.